Hello everyone, and welcome to an On-Chain 101 where we are going to be zooming in on the long to short-term holder cohort. Now, this particular heuristic is something that Glassnode developed back in 2020, and it's really one of these heuristics that helps us break up the supply to track the fast versus the smart money. We're looking at the supply and breaking it down based on how long different investors have actually held onto their coins. Now, on-chain analysis really does have this benefit of being able to cohort out different portions of the supply. We can look at both the supply held, but also the coins that are spent. We can look at the profit that's held and the profit that's locked in. And when we break up the supply by what we call these cohorts, these different groupings, we can do it via wallet sizes, whales versus shrimp, or in this particular case, we're doing it on how long the investor has held their coins, the long and the short-term holders. And the reason why we do this is that the longer that you've held your coins in the Bitcoin economy, both from a psychological standpoint, but also statistically speaking, the longer that you've held your coins, the less likely you are to spend them. You experience the volatility, your cost basis moves more and more into the rear view mirror. Price generally deviates both to the upside and the downside away from that cost basis over a 5-month period. So generally speaking, those who cross this 155-day threshold that we determine for long-term holders, that is essentially those that are more experienced with the volatility of the market. On the other hand, those that are younger than 5 months from a statistical standpoint are much more likely to be spent. And they're kind of like the hot ball of money that follows price around. They're far more volatile. They're more likely to react to both price rallies and price sell-offs. And much of the price action and price discovery day to day is driven by that shorter term holder cohort. So what we're going to look at today is a dashboard that we've recently rolled out that really explores this concept across many levels. This is actually full of a whole series of metrics that are now available to our advanced members. So this is part of our repackaging. We've brought a series of crowd favorite metrics, including long-term holder supply and a whole bunch of MVRV metrics. So all of the tools that you'll see today are available for our advanced members. But we are going to be exploring this from a whole suite of angles and how we can use the long and the short-term holder cohort and all of the tools that come alongside it to really assess what is going on during the cycles, look for cycle extremes, and really it's all about spotting behavioral shifts and behavior patterns. Let's get stuck into it. Okay, so here we are in the long and short-term holder essentials. And this is really a toolbox that really captures most of the behaviors that we see coming from the supply domain and also the unrealized profit and loss domain for these groups. So the first thing to note here is we have the long short-term holder supply in a stacked format. And it really gives us a bit of a view on the sense of scale. You can see that long-term holders hold the vast majority of the supply, so over 14.4 million at the time of recording. Short-term holders are significantly smaller, but on a similar scale to the exchange balances. So that's the first important takeaway, is that exchange balances plus short-term plus long-term equals circulating. So when we're looking at long and short-term holder behavior, we do actually exclude all exchange activity. So that's going to make up that kind of third component. The other thing you'll note is that long-term holder supply is quite cyclical. It has this quite wavy format, and it's generally filled in by the short-term holders. So you can see the short-term holders, when long-term declines, short-term typically increases and grows in overall size. And you can also see that this typically happens around bull market peaks. This is the long-term holders, of those who've acquired their coins at cheaper prices, taking profits all the way through the bull market, leading to an increase in the supply held by newer, less experienced investors who've essentially come in because the news cycle and all of the hype and all the excitement of a bull market, the smart money starts to exit their position at the same time as those speculators come in and take those coins off their hands. Naturally, the inverse is true. During those depressed periods, during bear markets, only those with the strongest conviction and the longest term time horizon step in, start accumulating, and hold on to that supply from that point on. And in many ways, what we're looking at here is one of those old market anecdotes, where during bear markets, stocks return to their rightful owners. That's essentially what we're seeing playing out here, where the long-term holder supply increases during bear markets, speculators are flushed from the market, and you essentially get this resetting of the cost basis. Now, you can see here we've got our long and our short-term holder supply. So these are the two input metrics to build that chart above. And this particular tool helps us understand whereabouts that 155-day threshold is. So we use that 155-day threshold because it really represents that statistical probability of when coins are likely to be spent. Coins that were acquired over the last 5 months are much more likely to be spent in the face of volatility. They tend to react to markets going up or down, whereas those with a longer term time horizon, including those from previous bear markets, some of those people are actually holding coins from the top. Some of them are actually holding coins that are in a profit, but they've experienced at least 5 months of volatility. In many ways, their cost basis is in the rearview mirror. It's much easier to remember your cost basis from last week than it is from last year. So we kind of see this psychological transition point on and around that 5-month, 155-day window. You can also see that these supply regions tend to move inversely to each other. Long-term holders spending their coins transfers them to newer, more speculative buyers. Likewise, when those speculative buyers leave the market, we see an uptrend in supply held by longer-term holders. So this is kind of this long-term process and this cyclicality that occurs between these different supply regions. Now, you'll often see here at Glassnode, we use things that we call net position change. And in this instance, we're looking at the long-term holder supply on a 30-day basis. So essentially, how much has long-term holder supply increased in the green or decreased in the red over a 30-day period? Now, it's really important to note that in order for a coin to become long-term holder supply, it has to age from 1 day to 1 week to 1 month until it finally gets to that 155-day or 5-month threshold. So the maturing of supply, when this metric goes positive, it actually is telling us a story about the supply that was accumulated 5 months ago. There's a time delay in that process, and a coin may be spent, and then it may spend some time in the short-term holder cohort. It may reach 1 week and then get spent. It may reach 1 month and then get spent. And it's only when it finally gets taken off the market and put into cold storage that it's able to migrate across that boundary and become a long-term holder supply. So what you'll often see is that long-term holder supply will increase during the middle of a bear market. It is forming that foundation. It's taking those coins off the market, but it takes a long time and even some downside correction. You can see the 50% sell-off here in 2018, and then we had the FTX event following all of this accumulation. So these things are a much more delayed response. Now, the opposite is true when long-term holders spend, because when a coin is spent, it will go from 1 year or 2 years or 6 months immediately to zero. What we are essentially seeing when long-term holders spend is this is an immediate reaction. So you'll see here that when long-term holder supply is declining, we get a negative print on the net position change during this 2021 bull. And this is immediate. We have no delay between when the coin is spent and this occurring. We will see this instantaneously. So it's just a little bit of nuance when looking at net position changes. Now this model is then looking at the same net position change, but on a 90-day basis, trying to look at the overall macro flow of funds between long-term in blue, short-term in red, and then that missing piece of the puzzle here in purple is the exchange balances. How much are exchange balances increasing or decreasing over that 30-day window? And what you can see is that these obviously act in opposite, where long-term holders are acquiring coins and holding onto them during bear markets. Short-term holders, speculators, and people who just came from the price are essentially leaving the market. This is showing that impulse of accumulation behavior, which, as you can see, takes some time to then manifest into the next market cycle. You can see during bull markets, short-term holder supply tends to increase rapidly. Long-term holders spend their coins, transfer them to new buyers, and we essentially see an oversaturation of the market. More suppliers come back online. The market is full of people who have kind of only just heard about Bitcoin. They don't have the same experience and conviction. And this is essentially what forges the bear market that follows. Now we can further explore this concept from the perspective of the long-term holders. So what this model is doing is looking at when are the long-term holders spending at a significant rate. So the way this particular metric, we call this a binary indicator. And what that's really trying to capture are periods when long-term holder spending is quite sustained, in this case over a 7-day period. So this indicator down the bottom here will hit the highest value it can of 1 when long-term holder supply has declined for 7 consecutive days, meaning that the long-term holders are spending supply out of their balance on a sustained rate for at least 1 week. When they have stopped spending and long-term holder supply does not decline for 7 days, it will return a value of 0. And you can see that these large impulses of long-term holder spending typically correlate with the peak mania of bull markets. It is literally capturing that overabundance of supply, these older coins that have been long discounted by the market, coming back into circulation, and in many ways, these experienced investors have a much better feeling for when the market is getting a little bit silly, a little bit overheated. We see these spending behaviors start to pick up. So you'll see that as the long-term holder supply decreases, their spending starts to ramp up and it gets increasingly heavy as we head into the later stage of the bull. And this means that by binary, there's a bunch of new buyers who've come in, and quite often during bull markets, they have less experience. They've kind of heard about Bitcoin on the news, or their friends tapped them on the shoulder and said, hey, you got to get into this thing. This is this overall cycle, this transfer of wealth to and from long and short-term holders. Now, one of our most popular tools that we have is actually looking at the on-chain cost bases. So what we look at here is, let's take our short-term holder cohort. We can measure the average acquisition price for all coins that are in that category. We can do the same for our long-term holder cohort. So the red trace that you can see here is the short-term holder cost basis. It is the average price at which all of coins that were accumulated in the last 5 months, it is their average acquisition price. In the blue, we've got our long-term holders, and in the orange is the classic realized price, which you can see is almost a mean or a median in between the two. Now, there's a couple of big observations here. We'll come back and look at short-term holder behavior and how it acts as support and resistance during a bull and a bear, respectively. We'll come back to that shortly. But the big takeaway notes here is, note how these 3 cost bases diverge during bull markets. We can see it here in 2021. We can even see it in 2019. This is the hot ball of money, the short-term holders following the price during the bull. Long-term holders have a disproportionate amount of folks who bought their coins in the previous bear and have a much, much lower cost basis, and the realized price is the average of both. So what we're seeing is that during bull markets, we get this large scale divergence between these two. Short-term holders chase the price, long-term holders distribute into the rally. During bear markets, and particularly late stage, note how they tend to converge. And in all of our previous bear cycles, the spot price has dropped below all 3 of these, which is signified by these purple zones. So this convergence is kind of telling us that irrespective of when you came into the market, whether you came in last week, 2 months ago, 5 months ago, a year ago, 2 years, if you take an average of everybody, it's a very homogeneous market. Everybody has a similar cost basis, which in many ways tells you that the speculators have been flushed out. Those who've held their coin, I mean, Max Payne is holding your coins from the top through all the volatility in the bear and still having a higher cost basis than someone who just entered yesterday. This is kind of that flushing out of all the speculators, reaching that point of seller exhaustion and a rehomogenization of the market. It's kind of a uniform, only the hodlers remain type environment. So this is a typical behavior we see in late stage bears. Now this chart is looking at those same cost bases, but looking at a 7-day rate of change. Periods when you have large increases in the cost basis, and this is on a percentage per week basis, large increases typically mean that the market is following price. There has been a lot of coins entering that cost basis with a much higher acquisition price. So the higher that these cost bases go, the more top heavy that cohort is and thus sensitive. So when you see these large impulses to the upside, it's telling you that the short-term holders here in red now have a much, much higher cost basis or an acquisition price than they previously did. And it suggests there may be a level of sensitivity to downside price. Likewise, when you get negative prints, it's showing you that their cost basis is declining very significantly. In other words, you're seeing that there's an acquisition going on at a lower cost basis. It's kind of telling us the opposite. You're getting this very, very low cost basis, and those that are in, when you acquire your coins at a cheaper price, it makes it that little bit easier to hold it. It's much harder for people to hold their coins from the very top of the market all the way down than it is to hold it from all the way down on the way back up. So it's kind of telling us these periods of influx of capital between these different cohorts. Now we then have a suite of MVRV ratios. So MVRV is a fundamental metric in on-chain analytics. What it's really, the best way to think about it, it is an unrealized profit or loss multiple. So you can see here on our long-term holders, this is the standard MVRV for the long-term holder cohort. So we're looking at all the coins in the long-term holder space. What is their average profit multiple that they're currently holding? And these two charts down the bottom here, we're essentially looking at those same charts, but -1. So when those cohorts are underwater on their position, on average, this will light up blue or red respectively. For these ones here, because they're the standard MVRV, they will always trade above a value of 1, and they're much easier to look at in log space. But for the long-term holders, you can see this is very much a macro oscillator. We go through periods where the long-term holders are underwater in late-stage bears, but then we see that their overall unrealized profit climbs and climbs, and during these bull market peaks, they can get up to 20x returns, not percent. This is 20x on their initial investment. So at a key psychological level, the way to think about this is that when people are in 20x returns, the probability that they're going to start spending and actually taking coins off the table, it starts to increase quite significantly. Now, when we move across to the short-term holder MVRV, because this is kind of the hot ball of money that follows price both in bulls and in bears, what we actually see is that it typically finds support on the break-even value of 1 throughout bull market trends. Conversely, during bear market trends, it typically finds resistance at that value of 1. So the psychological element that's going on here is that short-term holders are seeing their break-even level as an opportunity to add and build to their position and provide support during up markets. When we get these significant crashes down below that break-even value of 1, it becomes a please give me my money back. I want to sell on any exit liquidity that gets back to my original cost basis. We will explore this a little bit more in the next chart. So between these 4 different variants, really we're looking at long-term holder MVRV on the left, short-term on the right. One provides us with a very clear macro view of the overall profit and loss cycle, and the other one is much more on the micro time frame. Let's zoom in a little bit more into the short-term holders. Now, whilst the long-term holder MVRV is much better used as a kind of macro indicator, the short-term holder MVRV can actually be used on much smaller time frames. So for this particular one, we've got this viewed on an hourly time frame. And what you'll see is that we've got on here different levels for short-term holders being at a 20% loss, a 40% loss, or a 20% profit, 40% profit, 60% profit. Now, what you'll see is we tend to find very, very similar levels of resistance throughout the market cycle. So what I'm going to do is just zoom in on the 2015 forwards, just so we can get 2 different market cycles in kind of modern history. And here you can really see quite clearly when MVRV finds during these kind of uptrending markets, you'll see that 20 and 40% profits typically provide a level of resistance. This is showing you that that hot ball of money reaches these kind of periods of time of being overheated, both at local market tops, but then it comes back down and retests its cost basis on the shorter time frame. Now, the important thing to know is that because this is the kind of the ball of money that's following price around, when you get periods when it actually dips below their cost basis, this means that it is heavily weighted by investors who bought the local top. So what you're seeing is that when you get these consistent bounces off this level, it's telling you that there's a bit of a buy the dip mentality in the space. Now, if we transition over to bear markets, we can see the exact opposite. These retests of profitability, once we get these major sell-offs and sentiment really turns over, these retests of break-even become points of opportunity for exit liquidity. Those who have bought the local low as price rallies are taking that opportunity to actually get out of their position. And those that have been waiting for anything close to their cost basis to just get their money back are also taking opportunity. So we can see that both in the 2022 market as well as in the 2018 market, this acted as a significant level of resistance. So MVRV is really a bit of a multi-weather tool. We can use it for a great many different dynamics. We can also see a massive bearish divergence in the 2021 bull market. Price made higher highs consistently, but we had a deterioration in the profitability. Even though price was higher, the short-term holders were in less and less profit because their cost basis was getting higher and increasingly top-heavy, and thus very sensitive to any kind of sell-off. You will also see during the 2022 bear market, price continued to collapse, first down to 30,000, then down to 20,000, and then down to 15 when FTX blew up, but the profitability was actually starting to increase. We were getting a positive divergence during that late stage, telling us that even though price was lower, more coins had been reset to a lower cost basis, and you were seeing that capitulation, which means somebody else was accumulating. You're getting this kind of transfer of wealth from the speculators back towards the stronger hands. And remember, there's one very important nuance. Generally speaking, short-term holders reflect kind of the hot money that follows price. There is one exception to that, and that is near the bottom of a bear market. Because after you've seen all of this downside volatility, the short-term holders are those who recently acquired their coins. That's the right way to think about it. Short-term holders are those that recently acquired their coins. If you're recently acquiring at the market top, it's likely you're probably a little bit less experienced with markets. If, on the other hand, you're stepping in near market lows, you really have to have some serious conviction about this asset to be doing that. So in a very, very small period of time, near the late stage bear market, we typically see that short-term holders actually represent some of the highest conviction holders that Bitcoin has. And that is what this positive divergence is actually telling us. Towards these late stage bears, we're getting an improving profit and loss profile. Even though price trades sideways, the profitability is improving. Lots of coins transferred to a lower cost basis makes it easier to hold. Now, getting into our final metrics, we have the NUPL variant. This is the net unrealized profit and loss. These metrics are actually the same construction, very, very similar and derived from MVRV. They're just constructed in a slightly different way. It looks at the market cap, which is kind of the spot value of the this particular cohort supply, minus their cost basis realized cap as a percentage of the market cap. And we've got these color-coded to really show you the different kind of psychological zones, from denial and anxiety to euphoria and depression. It's really trying to pick up those different market cycles that you oscillate between during these kind of market events. Now, the last two models is kind of stitching a lot of those concepts we just talked about into a couple of indicators that are really trying to observe what goes on near psychological extremes, which we typically see during euphoric bulls and during these kind of really depressing and pretty violent downtrends and capitulation events. So the first one is looking at long-term holders. Long-term holders, as we've seen, typically are spending when their profit is the highest, and that's typically during bull markets, and they accelerate their spending as we head in towards those peaks. So what we have here is it's using MVRV in the background. It's looking at when we have MVRV, which is their profit and loss multiple. This metric will turn green and signify when they're in a huge degree of profit, over 350% profit on average, and their spending is increasing. So we saw that binary indicator above, and we saw the MVRV. When both of those are signaling, it means that they're in profit and they're starting to spend. When both of those metrics fire off, this will turn green. Likewise, at the absolute bottom, even those who hold their coins through the entire bear market, they buy the top, They get to the 5-month threshold. They're white knuckle, gritting their teeth and saying, I hope this thing goes up eventually. Even some of the most hardcore hodlers get flushed out near the bottom. So this is then picking up when the MVRV metric drops to at least a 25% loss on average, and the binary indicator fires off. So we see that they're not only under significant financial stress, but they start spending as well. So it's really combining that profit and loss with the spending behavior to try and identify these capitulation periods in red and these periods of extreme euphoria in green. Now, for the short-term holders, it's a little bit harder to look at their spending behavior because they represent so much of the spending behavior. Long-term holders are typically more active around cycle extremes, whereas short-term holders are active all the time. So for this, we're purely looking at MVRV and we're using a statistical framework here. We're essentially looking at when the MVRV is above one standard deviation, which is what we see here in the green. When price has really extended some distance above their cost basis, short-term holders are in a very, very improbable amount of profit. That's what is being flagged by these green zones. You can see that they show up far less frequently than our long-term holder equivalents. They are typically occurring during those euphoric parabolic runs where things are getting a little bit silly. And likewise, when we get a negative one standard deviation move, it means that the recent buyers have suddenly found themselves in an extraordinary amount of loss. So this again will fire off and turn red when we get below that one standard deviation band. And just to close out, let's look at our MVRV indicator. You can see that typically through most of history, we are bounded between these 0.4 levels and 0.6. The standard deviation bands are when we blow right out the top from this perspective and right out the bottom from the negative perspective. So that's essentially what that model is picking up when we get above these extremes and below the extremes on the MVRV indicator. That's really what that indicator is picking up on both the upside and the downside. So thanks for tuning in for that session, folks. Hopefully you found that useful and informative. The long and the short-term holder cohort is a really, really powerful tool. We use it all the time, and it's a nice way to visualize both the fast and the slow, the cycles at the extremes, but also what's going on in between. So do let me know if you have any comments or thoughts in the comments below, and I will see you in the next video. Cheers.